Ladies and gentlemen, good day and welcome to the Q3 and 9 months FY22 results conference call of the Phoenix Mills Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Management of the company has been represented by Mr. Shishir Shrivastava, Managing Director, Mr. Anurag Shrivastava, Group CFO, Mr. Varun Parwal, Deputy CFO, and Mr. Pawan Kakumanu, Deputy CFO. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. At this time, I would like to hand over the conference to Mr. Shishir Shrivastava. Thank you, and over to you, sir.
A very good morning, ladies and gentlemen. As always, it is our pleasure to welcome you all to discuss the operating and financial performance of the third quarter and 9 months of FY22. Today, before we begin with the results update, I would like to take this opportunity to extend a warm welcome to Mr. Anurag Shrivastava, our Group CFO, who has joined us from December 2021. Anurag brings with him a rich and varied experience of more than 25 years across diverse sectors like FMCG, retail, telecom, and infrastructure, and across geographies. Most recently, he served as the Group CFO at Sterlite Power Transmissions Limited. Prior to that, he has held senior positions at Tata Teleservice, Indus Towers, GSK Consumer Healthcare, and the Future Group. With our company undergoing a period of fast-paced growth and transformation, Anurag will be responsible for driving the company's overall financial and capital allocation strategy, unlocking shareholder value, future fundraise strategies, mergers and acquisitions, digital transformation of the finance and accounts division, amongst others. These initiatives will help the organization to manage, scale, and evolve our businesses as we continue to accelerate our momentum. Anurag, a very warm welcome and wishing you lots of success.
Thank you, Shishir. I'm really excited to be part of Phoenix Mills family and look forward to a fulfilling journey with the company.
I would now take you through the key highlights of our results. In the retail business, consumption was at 2,070 crore in Q3 FY22. Likewise, consumption in Q3 FY22, including Phoenix Palacio at Lucknow, was at 100% of Q3 FY20, which is the pre-COVID quarter. Excluding Phoenix Palacio, consumption in Q3 FY22 was at approximately 89% of Q3 FY20. Consumption in 9 months FY22, including Phoenix Palacio, was at 60% approximately of 9-month FY20. However, it's important to note that most of our coveted mall assets in Maharashtra were not operational for most of April through September period. In January 2022, our operational malls recorded a consumption of approximately 493 crore. This is at approximately 79% of consumption against Jan 2020, which is the pre-COVID period, and 70% adjusting for consumption of Phoenix Palacio. January consumption was, however, impacted due to increasing cases and the third wave of COVID and local restrictions in certain states. This is on par with October 2021 consumption levels. Further, trends observed in the first week of February indicate that consumption is back to pre-COVID numbers. As on date, most restrictions across states have been lifted and malls are close to resuming normal operations. Our retail collections have improved substantially. In Q3 FY 2022, we witnessed an all-time high of collections which stood at approximately 448 crore, while for the 9-month period of FY 22, collections stood at approximately 698 crore. January collections remained strong at over 130 crore. Overall, we remain positive in our consumption recovery outlook for the fourth quarter on the back of improved vaccination levels and resumption of normal operations across categories. Moving on to the commercial office portfolio. Our office portfolio continues to remain resilient. Collection efficiency for the portfolio was in excess of 95% in Q3 FY22. Fountainhead Tower 2 has seen strong leasing traction with approximately 48% of the gross leasable area getting leased so far. Fountainhead Tower 1 in Pune has a leased occupancy of approximately 95% and is fully operational. In December 2021, we also received the occupation certificate for Fountainhead Tower 3 at Pune and expect the to start generating rentals in the next few months. During the 9 months of FY 2022, we have signed new deals of approximately 1.9 lakh square feet, of which roughly half is operational, and the balance will become operational in the next 2 quarters. We have renewed deals for approximately 2.1 lakh square feet during the 9 months in Mumbai. 9-month FY 2022 office has benefited from rental contribution from Fountainhead Tower 2 and the income is likely to improve in the coming quarters as over 100,000 square feet of area becomes rent generating in the next 1 to 3 months. To summarize, we have done a leasing of approximately 4 lakh square feet in 9 months FY22, of which renewals is 2.1 lakhs and new deals is 1.9 lakhs. A quick update on our iconic project at Lower Parel, Project Rise. During the quarter, we executed agreements with the Canada Pension Plan Investments to develop a flagship office-led mixed-use development, which will substantially complement our existing retail and hospitality landmarks at Lower Parel. We expect to add office GLA of approximately 1 million square feet and retail GLA of approximately 200,000 square feet at this new project. We have also made significant strides in securing approvals and crystallizing the development potential for Project Rise. We have received the command certificate for the project and are currently in advanced stages of design development. We are very confident of building an iconic office landmark destination for the city of Mumbai. Meanwhile, we are also progressing with our plans for developing offices at our malls, at our mixed-use projects at Wakad in Pune and Hebbal at Bangalore, and also at Chennai. And we expect to share more detailed updates as things crystallize at our end. Moving on to the residential business. We have witnessed good traction in residential sales, mainly led by the reconfiguration of our Kesaku property into smaller units and the robust demand for ready-to-move-in inventory. Between April and December, we have sold inventory worth 130 crore. During Q3, we have sold inventory worth 32 crore. For 9-month FY22, we have additionally sold 31 crore of inventory, which is yet to be registered, taking our 9-month FY22 sales to approximately 161 crore. Our collections from residential business during the 9-month FY22 was at approximately 178 crore. In the month of January itself, we have sold inventory worth 18 crore and collected more than 22 crores. We are seeing strong build-up in demand and faster conversions for our ready inventory, and we are stepping up all our efforts to sell inventory by launching attractive subvention schemes for the entire development, special offers on ready-to-move-in inventory, and digital marketing campaigns to widen the reach of our product. Momentum in sales is expected to continue in the coming quarters as well. A quick snapshot on our hotels. The hotel business showed strong improvement on the back of higher occupancies, social events, and F&B. The St. Regis Mumbai reported revenues of 55.3 crore in Q3 FY22. This is up 93% Q on Q and 140% year on year. While occupancy levels have reached pre-COVID levels in Q3 FY22, we expect average room rates to increase as well going ahead with the resumption of business travel and relaxation for foreign travelers. Similarly, Courtyard by Marriott had a good quarter and contributed approximately 10.1 crore in the third quarter FY22 with average occupancy of approximately 66% and ARRs in excess of 4,260 rupees. Our under construction projects, a quick update on that. Our current pipeline of under construction malls, Phoenix Millennium at Pune, Phoenix Citadel at Indore, Phoenix Mall of Asia in Hebbal, and Phoenix Palladium in Ahmedabad, and our newest mall in Calcutta will take up our portfolio of retail to approximately 13 million square feet of GLA. Construction work at all our sites is on in full swing. We expect Indore and Ahmedabad malls to be operational by mid to second half of FY23, and both Pune and Bangalore new malls should become operational by the first half of FY24. Retail interest in our under construction assets remains very high, and we have seen significant traction in leasing activity in the quarter gone by. We expect Phoenix Citadel at Indore to cross 75% of leasing by March 2022. Phoenix Mall of Asia at Hebbal, Bangalore should cross 50% by the end of this financial year, and similarly, Phoenix Millennium at Wakad, Pune will also exceed 50% March 2022. Phoenix Palladium, Ahmedabad is already leased at over 75%. May I now request Anurag to update you on the financial performance. Thank you.
Thank you, Shishir. Good morning, ladies and gentlemen. Continuing with the briefing which Shishir gave, I would like to share with you some of the key highlights of our consolidated financial performance. Our income from operations for quarter 3 FY22 stood at 425 crores and rupees 988 crores for 9 months FY22. Quarter 3 FY22 EBITDA was about 231 crores, while for 9 months it was at 493 crores. Retail income came in at about 261 crores in quarter 3 FY22 and 546 for the 9 months. Quarter 3 FY22 retail EBITDA was 251 crores, 31 crores for the 9 months. Our commercial office portfolio reported a total income of 37 crores in quarter 3 FY22 and EBITDA of 21 crores. For the 9 months, the commercial income came in at 115 crores and EBITDA was at 71 crores. While we remain confident to do an EBITDA in excess of 100 crores for the full year as occupancy ramps up across some of our assets. Our income from hotels was 65 crores in quarter 3 FY22 and 115 crores for the 9 months. Moving to collections, our gross collections from the business came in at about 1,113 crores for the 9 months of FY22, out of which retail contributed 698 crores, commercials was at 122 crores, residential at 178 crores, and hotels at 115 crores. This resulted in a 9-month FY22 EBITDA of 493 crores and operational cash flow of 418 crores after payment of taxes, etc. Proceeds from our PE transactions with CPPIB and GIC were 2,600 crores for 9 months FY22, while our capex for the same period was 959 crores. Our liquidity position as on 31st December 21 was rupees 2,495 crores, an increase of 758 crores as of 31st March 2021. This excludes undrawn OD limits of about 685 crores which are available to us. So as a result, our consolidated gross debt stood at about 4,305 crores as of 31st December as compared to 4,299 crores at the end of quarter 2 FY22. This is up by about 6 crores. Our average cost of borrowing continues to go down. It went down to about 761 from 7.84% last quarter. Cost of borrowing is further expected to decrease post refinance of certain existing loans which we are planning going ahead. PML's share of gross debt is about 3197 crores Adjusted for the liquidity available with PML in form of bank balance, investments, etc., PML's share of net debt is 1,264 crores only. We strongly believe that tough times are behind us now. With this extremely strong balance sheet position and liquidity position, our focus is now to deliver on our under construction projects in time and judiciously deploy our capital to expand our portfolio. With this, we would like to close our opening remarks and we'll open up the call for an interactive question and answer session. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Parikshit Kandpal from HDFC Securities. Please go ahead.
Hi sir, congratulations on a good quarter. My first question is, if I see your slide, so the trading occupancy is still lower than it's not converged with the leased occupancy. So just wanted to understand that with respect to like-to-like comparison versus pre-COVID, so once these two numbers converge, so on a like-to-like basis, what could be the exit rentals? So that's my first question.
Yeah, hi. Your question is why the gap between trading occupancy and leased occupancy?
No. So I wanted to know, once these two numbers converge, so on a like-to-like basis versus pre-COVID level, what kind of annual rentals in the malls we are now averaging? So once these numbers converges towards the leased occupancy.
So we have, across all our assets, we have several stores which have either undergone a churn or they have gone into refurbishment. So we expect this to converge probably in the next, I would say in the next 2 quarters. We expect to see our trading occupancy move up to closer to 90-92%. A positive impact of this to the rental income, would be across the portfolio should be approximately 100 crore. This does not include any rent escalation, which will further take the rental income up.
So Shishir, once you have the rental escalation in place and the trading occupancy moving towards the headline occupancy, so we were averaging about 1,000 crores of rentals pre-COVID. So what that number would be once these two things happen, say by FY23 exit? So excluding Palassio, I'm saying, and any new mall, just like-to-like comparison.
I think to answer that question, we should see, let's say, an annual run rate of about 1,200 crore, including Lucknow, after, let's say, from June onwards. That would be our estimate.
Okay. The second question is, any rethink on the business development pipeline, so where we have been partnering in each and every mall. So now, with COVID largely behind us and with such a strong balance sheet and cash position, I mean, if I include the real estate unsold areas, so it's hardly any debt on books for the PML shares. So any rethink that for neo malls, maybe our stake may be near 100% or maybe much higher than how we have been diluting with the partners. So any rethink there for the business development pipeline?
So I would say that our focus at present is to deploy the capital that we have raised in the GIC platform. And there are several opportunities that are under evaluation in various geographies. We continue to look for opportunities even beyond that. And for us, without having much debt, we have strong partners at the asset level. I think growth is imminent. It's about just getting the right opportunity. We have enough liquidity on our balance sheet, as you rightly pointed out, to be deployed for such opportunities.
So my last question is, so could we see acceleration now on the BD side, given that you were earlier looking to add about every year a mall, new mall, so can there, because we have a strong balance sheet position, so can there be acceleration in the new BD pipeline where we can have some projects where we have 100% near 100% stakes and some project maybe with partners?
Sorry, can you repeat the last part of that question? I didn't understand the 100% stake part.
So I'm saying we have been diluting with partners like CPPIB and GIC, maybe potentially there's some capital to be deployed with GIC. So given that the worst of the COVID is behind us and with a strong balance sheet, we may look at adding more malls now in a more accelerated way, wherein some malls we may have 100% economic interest and others we may continue to partner with CPPIB or GIC.
So I'm really sorry, but your line is a little weak. I'm not able to appreciate what is the question. Is the question that are we evaluating acquiring assets outside of our partnerships?
Yeah. So I was saying that we have given a guidance that every year we'll be adding a new mall beyond FY25. So now since the balance sheet is so strong and most of the other competitors also are looking out at adding malls, do you think that given the strong balance sheet we have, we can add more malls beyond that one number? And can we have, like, in some malls 100% stake economic interest, while in some malls we may continue to partner with CPPIB or GIC?
So I'll break this up into two parts, my response. We had a stated goal of increasing our retail GLA to excess of 12 million square feet, which was our goal that we had set out for ourselves in 2018. This was pre-COVID. We are well on track delivering that goal. In fact, we wanted that number to be at 12 million by FY24, and we expect to be achieving that. We had also a stated goal that each year after that we would add approximately 1 million square feet. With the Calcutta acquisition, the FY25 target is also in place. We are extremely active on the BD side. We are looking for opportunities in the markets of Hyderabad, Surat, Jaipur, Chandigarh, Navi Mumbai, amongst others. So we are active there, and I think we are well on track to continue adding 1 million square feet of our portfolio even beyond FY26. Having said that, your second part, whether we will be looking at adding assets on our own balance sheet with a 100% stake, at present we do not intend to dilute any further to raise any capital with any private equity partner on any of our existing assets. We do have liquidity in our JV platforms, which we are going to be looking at deploying. And I think it's going to be a little opportunistic. Some assets we will be acquiring through our JV platforms, and some may be outside of that as well, depending on our partners' preferences.
Okay, Shishir. Thanks for the answer. I'll join the queue for more questions.
Thank you. The next question is from the line of Puneet from HSBC. Please go ahead.
Yeah, thank you for the opportunities and congratulations on good numbers returning back to normalcy nearly. My first question is, you talked about leasing of the new upcoming malls reaching almost 50%. Is it still LOI or is it the commitment number? How should I read this?
So when we hi Puneet, when I mentioned that Phoenix Citadel Indore should cross 75% by March 22, this would be a committed number with an LOI executed and security deposit received.
Okay, security deposit received. Okay.
Yeah, and similarly, that would be the case with all the other mentioned.
So even where Bangalore, Pune, where you have 50% committed number with security deposit received already?
By March, we expect to be at that number.
Okay, by March. Okay. And Ahmedabad, you said about another similar 85%.
Already received. Yeah.
85 already received security deposit.
75 is where we are, where we've already received security deposits.
Okay, that's very good. Second is, how is there any thought from retailers or any push from retailers to renegotiate rentals during the Omicron impact?
Not particularly. Puneet, nothing as such. This was I would say it was a short wave, and the resurgence of or the bounce back on consumption, which was at the same in January, despite 2 weeks of impact, January consumption was similar to October 21.
Okay.
Yeah. And last 2 weeks, the consumption has been near to 100%.
Right.
2020, Jan 2020.
Okay. That's interesting. And
that kind of gives the the confidence to the retailers, and there's therefore not been any discussion on negotiation of rentals.
Understood. So you're saying that by February things have returned back to normal in terms of consumption, trading, etc.
Yes.
Okay, that's good. The last one is on if you've been able to conclude your discussions with cinemas and food court. Any comments there?
So we've concluded our discussions with all cinemas and all F&B operators at food court, even otherwise, and even the other dine-in restaurants. There's nothing. There's no deviation to really respond or report on right now.
No, so will they come back to normalcy from 4Q, or is it going to be 1Q in terms of rental contracts and all?
Multiplexes, for example, Q3 consumption across the board, multiplexes were at 10% above Q3 FY20. So
10% above FY20, Q3 FY20.
That's right. January was, of course, impacted because again of the restrictions and the wave, and but Q3 numbers were quite gave us a lot of confidence.
Yeah. Okay. So I would presume that
actually several of our F&B operators are seeing very, very good business. In fact, if you just look at Q3 numbers, they were at the consumption in F&B was at about 2% higher to the pre-COVID period.
Okay. That's good. So despite the fact that actually in many places they were still 10 to 20% lower, or an average 11% lower on consumption Q3 FY22 versus Q3 FY20, cinema was higher and food court was higher by 3%.
That's right.
Oh, very interesting. So is it fair to assume that 4Q FY22, which is the current quarter and next quarter, the cinemas will be back to their normal run rate in terms of paying rents, etc.?
I would we certainly hope so, because I think it would be better for us to observe for the next month or so, and then it also depends a lot on the content that's available to be.
Yeah. No. What I mean to say is there is no concessional deal given to them for this period.
That is it.
Okay. That's great. That's all from my side. Thank you so much. All the best.
Thank you. The next question is from the line of Pulkit Patni from Goldman Sachs. Please go ahead.
Yeah, thanks, Shishir. Thanks for taking my question. Shishir, my first question is in continuation with the previous one. So while we've seen consumption being pretty robust, rental is still not caught up to the same level. So any, again, checking any concessions that were given in Q3, and how should we look at this trend going forward? Because across most assets where I see we are at about 80-85% of pre-COVID, whereas except for even if you take out Palacio, our consumption numbers are almost there. So that would be my question number one.
Yeah. So I would say that there would be in Q3. FY22 excluding Palacio, our rental income was at 236 crore, and pre-COVID quarter was at 270 crore across our entire portfolio. But if you look at specific malls, right? Look at Bangalore. Bangalore was at 97%, 38.6 crore versus 40 crore. Phoenix Market City, Pune was at 43.2 crore. Versus 45.8, so it was in close to 95%. All of our assets have been trending closer to that 95%, 90-95% range. Mumbai, because of the severe restrictions, did see an impact, and those restrictions continued on into Q3. And in fact, Mumbai and Pune only opened up by the end of October fully, as such. So there was an impact in that quarter. But overall, if we look at the overall rentals, overall we were at about close to 87% compared to pre-COVID levels. And Mumbai, Pune, our three assets did see an impact of the restrictions and being shut until September and October.
No, but consumptions there were almost back to normal. So you are saying there was no additional concession that were given to any of the tenants then, and in which case, I mean, if we adjust for January wherever it is, our rental collections will also catch up, is what you are saying, very soon. Is that the right way to look at it?
The right way to look at it is there were some adjustments for the billings done in Q1, Q2, which were negotiated during the period of Q2 and Q3. And that impacted our rental numbers for Q3, reported in Q3. But for that period of Q3 itself, there were no really remarkable concessions.
Got it. So whatever has to be done is done and dusted now, and going forward it will be a normal number that one should expect.
That would be correct.
That would be correct. Okay. My second question is just looking at our commercial portfolio, and I clearly see an increased focus from us on commercial. I mean, even if we look at Project Rise, which is predominantly a very, very, robust retail asset for us already, we are doing a lot more commercial, and that too when our rental collection or our rental rate is not probably one of the highest in that micro market if I look at Lower Parel. So just wanted to get a sense of why 1 million commercial and 200,000 retail there, why not full retail, just a sense on the thought process there.
Okay, so we are taking the benefit of the development regulations to be able to go under the CBD scheme and develop the maximum FSI potential. However, it's important for you to understand that the area where one can build this, the footprint is very limited. And as you go higher up, you can do a mall which may be ground plus 3 or ground plus 4 level, but beyond that, retail won't really work. Therefore, the tower portion is going to be going to be for an office.
Okay, so it's basically trying to optimize the space that we have available at that location.
Yes.
Got it. That answers my questions. Thank you.
Thank you. The next question is from the line of Aditya Chattopadhyay from ICICI Securities. Please go ahead.
Yeah, good afternoon, everyone. Thanks for the opportunity. First, just a clarification on how the rental agreements were currently in Q3 and in Q4. So, is the understanding have most of the tenants moved back to the minimum guarantee sort of arrangements pre-COVID, or is there still some time to go for that? And if what is the percentage also in the overall tenancy on minimum guarantee? Thank you.
Almost all tenants have moved back to contractual minimum guarantee rent, and many of them with escalations as well.
Okay. So would you share some percentage numbers? Is it like 85-90%, or like I'm just trying to adjust for multiplex?
It would be closer to 95-96% have moved back to contractual rent.
So this is from January or from previous quarter?
This is from January.
Okay, from January. And is there any further collection spillover which may happen in Q4 from the previous 9 months of the year from the rental collections?
Collection spillover, yes, of course, there will be.
So, sir, a reasonable assumption is this number maybe on a group basis, our retail rental income may cross 800 crores for this year. Is that a correct way of looking at it? Means we at least achieve the run rate we have achieved in Q3 of 260 crores group level.
I would think, we should be somewhere. So let's say for 9 months, our number was at about 9 months rental income was about 550 crore.
Yeah.
I would add perhaps another 200 odd crore coming in the last quarter. So say 250 crore more. So that would take us closer to 800 crore.
Okay, so that is, I think, the minimum and something higher. And have the overall revenue sharing also, have we gone back to pre-COVID, or is it now higher share of revenue? Sorry, the revenue share portion will be higher this time compared to pre-COVID at a portfolio.
Yes, there would be some spillover of our negotiations with retailers, where for a period after discounts and on minimum guarantee rent, we would be accruing a higher revenue share. So that should probably continue until in several cases till March of this year, and in few cases till July of the year.
Okay. So my next question is on the escalations. As you talked about, so at a portfolio level, what would be sort of a blended sort of escalation in FY23, considering like we would have almost 3 years, a couple of years washed out due to COVID, and overall the inflation which has been there during that time.
I would suggest you connect with Varun offline and get a detailed breakup on this. Compared to, let's say, if we just look at the last quarter, compared to quarter ended December 2019, our MG would be up by approximately 10% in the quarter ended December 21.
Okay, and no, so my question is more for what are we looking ahead, like in FY23, right? Means once things normalize and everything, right? So what is the sort of escalations one could expect at a portfolio level? That is more on a forward-looking question.
It's not a very simple and straightforward answer. We are looking at that there is a significant churn which is ongoing at several of our assets, and we are looking at new categories and new retailers coming and taking up that space. I would think that I don't have a overview on what could be the escalations arising out of these changes, so it would be incorrect for me to hazard a guess.
Okay. And last question is just on our 4 upcoming malls, right? Indore and the rest, Ahmedabad, Bangalore and Wakad. What is the indicative rentals we have done the leasing at? If you could just share till date for whatever you achieved.
Indore is roughly at about close to 90 rupees a square foot. Ahmedabad is close to about 150. Bangalore Hebbal is at about 160 again, and Wakad Pune would be about 115 to 120. But this is all the mall level average, since we have leased across different categories.
Yeah, sure. No, so that's pretty helpful. Yeah, that's it from my side. Thank you and all the best.
Thank you.
Thank you. Before we take the next question, a reminder to the participants, please limit your questions to 2 per participant. Should you have any follow-up, may we request you to rejoin the queue. The next question is from the line of Kunal Lakhan from CLSA. Please go ahead.
Yeah, hi, good afternoon. Shishir, since mall operations are stabilizing across the country, how are you looking at the new acquisition landscape now? Are the deals fewer versus say a year back, or the terms are getting less favorable versus a year back, or is it otherwise?
So, Kunal, we were scouting for opportunities in completed or operational assets, but we didn't find many malls which would meet our specifications or design standards. So for us, the focus has only been acquiring greenfield opportunities, land. Land pricing really we had not seen any reduction or drop in land pricing in the last year or as such, and it continues to remain stable. So we are looking at greenfield acquisition opportunities across the markets that I had earlier mentioned.
Sure. But are the land price? You're saying the land price is still the same. There's no change over there.
I would say the stress may have reduced a little bit, but we have not seen any significant movement in land pricing as such. Because if we are looking for opportunities, for us, we are looking at 8 acres going up to 15 acres, 16 acre land parcels, and there aren't too many purchasers for that size, And also, as a matter of fact, like I said, the prices had not really dropped in the first instance. Landowners had not dropped their expectations on their pricing in the last year and a half. So it kind of remains stable.
Sure. My second question is on the ARR side. Like, your occupancy in the hotels is very close to the pre-COVID levels, but ARR was like 40% below the pre-COVID levels. So by when do you think this ARR will normalize?
So in Mumbai, the ARRs, and we've been tracking all our comp set, I think generally across the board, ARRs have been in the range of 7,000, 7,200, 7,500. The last quarter has been all about getting the occupancy up. And we expect to see, it's pretty typical when you start seeing a higher occupancy in excess of 75%, the ARRs start moving up. If I were to just crystal gaze, I'm hopeful that in this next quarter, Jan, Feb, March, typically, which is a slow quarter, but there are a lot of several corporate events and social events that are lined up that should take our ARRs up. But whether it's going to hit 10,000 or 12,000, which was the pre-COVID level, I can't really hazard a guess again on how long it will take to reach that. It all depends on demand.
Okay. My last question is a bookkeeping question, actually. So if you can give us overall balance capex on your under construction portfolio, and if you can break that up into Indore, Hebbal, Wakad, and Ahmedabad also.
I can give you approximate numbers. If we just look at the malls, our total capex across malls. Just allow me 1 second, Kunal.
Sure.
So across our malls at Phoenix Millennium, Pune, Wakad, Mall of Asia at Hebbal, Phoenix Citadel at Indore, and Phoenix Palladium at Ahmedabad, we've so far spent about 2,485 crore. The balance cost to complete is estimated at about 1,540 crore.
1,540 crores.
Yeah.
Okay, and this will not include Project Rise.
No, this will not include Project Rise. These are only the 4 malls which are under development, which are going to be delivered between FY23 and FY24.
Okay, great. Possible to give a breakup, or should I take it offline?
Yeah, you can reach out to Varun and Advait offline.
Sorry, and one last question on how much was the spend on approvals in Q3?
Sorry, could you repeat that question?
How much was the spend on approvals or FSI premiums in Q3?
On approvals?
FSI premiums were paid pertaining to Project Rise?
Pertaining to Project Rise.
Yeah.
So in this last quarter, I think we've spent about 35 crore on some of the premiums, etc., that had to be paid. If you need further details on the granular level, you can again connect with Varun and get that information.
Sure. Thanks a lot.
Thank you. The next question is from the line of Prem Khurana from Anand Rathi. Please go ahead.
Yeah, thank you for taking my question, sir, and congratulations on good set of numbers. So, sir, my question was with respect to our tenant mix. Because of this COVID situation, the way the things have been in the recent past, I'm sure, when you would have realized the way some of these categories are kind of reacting to the COVID situation, or were required to kind of make changes. So do we envisage any meaningful change in our, let's say, tenant mix in terms of categories, let's say either by design, because categories are not the right fit for you now after COVID, or by choice, wherein some of these tenants would kind of move out on their own, wherein they don't get to feel like when they are required to stay back and in these malls anymore?
Prem, not particularly. If you're asking if there's a fundamental change in our approach on our category mix,
Sure.
I don't know. I don't think so. If we have seen several of our F&B operators, going through a lot of financial stress, but that also seems to be behind us simply because the demand on F&B side has been extremely high. So entrepreneurs have been able to sustain themselves and raise capital. There may be few vacancies on that front, but as such, there is no likelihood of any fundamental change in our category mix.
Sure. And any change in the way you structure your agreements now? Have you been approached by any of these clients wherein, they want you to have more of revenue share and less of minimum guarantee now because they want you to kind of get aligned more on with the business prospects or the way the consumption would kind of shape up going forward?
Again, no structural change in the revenue share versus minimum guarantee rent.
Sure. And just one last bookkeeping question. The liquidity that you talk about, 2,500 odd crore rupees, possible to share? How much of this is essentially fungible? I understand you have 2,500, but a large part of this money is lying in some of these SPVs, let's say CPPIB, Island Star, which is meant for a specific purpose, or Calcutta, that again is meant for specific purpose. So how much is the free capital, which is your actual own capital, wherein you would be able to use it for your growth in your personal capacity and not in JVs? Hello?
So we have I would say that we have liquidity of about 900 crore at Phoenix Mills Limited level.
Sure.
And in addition to that, we have undrawn OD limits of about 680 odd crore.
Okay. Sure, sir. Thank you. That's it from my end. All the very best of you.
Thank you. Next question is from the lineup, Amandeep Singh from Ambit Capital. Please go ahead.
Thanks for the opportunity. So, Shishir, my first question is on the competitive landscape. So, what we hear is that Lulu will be opening its mall in Lucknow by April, and separately they have also announced investments in Ahmedabad recently. So, in that context, can you give us some sense on how the upcoming supply in your key micro markets would stack up, given you also have a sizable pipeline across micro markets? And any initial sense on how Lulu's recent mall in Bangalore would have done, given the offerings like hypermarket or a entertainment center like Furniture? So how their products would differ from yours? So some sense on that?
I really don't have a comment on Lulu's mall and its performance. I think when they opened in Bangalore, they were very widely well accepted. We have not seen a dent in our consumption or our business on account of the mall opening there. There is also a fundamental difference in the category mix and the brand mix that we have between our two malls. I think there is that's a bit of a differentiator between us and them. On a pan-India basis, there aren't too many malls that are being built, and we remain confident in our own model.
Sure. Thanks for this. And whilst we agree that Bangalore mall won't be having any impact because of different location, will it be fair to assume that similar would be the trend because of Jio World Drive in BKC? Again, a bit different locations and target audience, so no impact on your Mumbai malls?
Yes, again, I would say that the Jio World Drive in BKC, again, a very, very good quality asset. It's not really impacted our consumption, neither at Phoenix Palladium Lower Parel nor at Phoenix Market City at Kurla. I guess it's again a combination of a different category mix and different brand mix.
My second question is on the residential side. So we acknowledge that Bangalore as a micro market has been doing well and also has been reported by the other listed players. So in that context, any sense on when do you think that the company will be able to monetize the entire residential portfolio?
So currently we are selling our ready inventory, which is largely in Kesaku, and some inventory at Tower 7 of One Bangalore West. We still have to launch Towers 8 and 9. I think considering what the velocity, it would be fair to estimate a 20 crore per month kind of a sales velocity, which we expect to be continuing to see going forward as well. By our best estimate, I think we should look at being able to exit Tower 7 and Kesaku in the next 30 odd months.
So that's very helpful. And one last question, if I may squeeze in. So two of your assets, Pune and Chennai, have seen some impact on the leased occupancies amid the COVID. So in that context, can you help me with thoughts on the traction of fresh leases over here, and which category tenants would be in inquiries to expand over here?
Did you call out specifically Phoenix Market City, Pune in your question?
Yeah, Pune, Phoenix Market City, Pune, and Phoenix Market City and Palladium, Chennai. So these two assets.
Yes, I think the pertinent number to look at is not the trading occupancy, it's the leased occupancy. Because leased occupancy is, as I mentioned earlier during the call, we have seen several of our stores or our brand partners either moving out and new ones moving in, or some of them renovating their stores. So as a result of that, the trading occupancy may be showing lower. But Phoenix Market City, Pune is still at a leased occupancy of 91%, and Phoenix Market City, Mumbai is still at a leased occupancy of 94%. And the trading density, on the trading density side, for the areas that are operational, in Pune we've not seen much of a difference. In Mumbai, yes, there has been a reduction from 1,400, it's been come down to close to 1,100. That again was more because of not because of the stores not performing. It was because the stores were shut. The malls were not allowed to operate, and we really started seeing the malls becoming operational end of October. So that's why in Q3 there was an impact.
Shishi, just to clarify, I was on not about the Mumbai, on the Chennai. So your leased occupancy is at 90% versus the 97% pre-COVID. So I just wanted to get some sense on which tenants would be thinking to expand over here, the category of tenants which would be sending inquiries to expand.
In Chennai, we are seeing a transitional vacancy because at Palladium, we are also seeing the first renewal cycle coming to an end. So that is the transitional vacancy on account of that. And that has, and in addition to that, we have some mall upgrade going on in Phoenix Palladium at Chennai as well. Is there a second part to your question?
No, that's all. Thanks for this and all the very best. Thank you.
Most welcome.
Thank you. The next question is from the line of Biplab Debbarma from Antique Stock Broking. Please go ahead.
Hello. Good afternoon, everyone. So most of my questions are answered. Still, two questions from my side, sir. I'm just trying to understand, you have been mentioning churns, significant churns. Could you give us some insight what kind of churns, why this churns happening?
It's end of contract related churns.
So significant. So is it like a lot of renewal happening this quarter? Is that what you meant? And new tenants would be replacing some of these old tenants who may not be renewal. Is that what you mean by churn, significant churn? Hello.
So in Chennai, as I mentioned, we do have the end of the first renewal cycle which has kicked in, and there is a churn on account of that. We are also looking at, in several locations, we are looking at relocating some of our existing tenants within the mall to other locations and creating, luxury zones, etc. So there is an improvement in the tenant mix that we are looking at across these locations. If you would like to really understand what was the exact vacancy in this quarter on account of renewals or on account of such churn, you can reach out to Varun and Advait for more granular information.
Okay, that's fine, sir. No. Second thing is just trying to understand on the footfall level, consumption level. You have given us clarity on the footfall level. Has any of these months or weeks has the footfall level crossed the average of pre-COVID level?
The footfalls are at about 70 to 75% of pre-COVID levels.
Okay, still it is at around 70 to 75%. Last time also that's what.
Yeah, but again, if you look at this is the average for the quarter, right?
Yes, sir.
So again, bulk of our malls in Maharashtra have not been open for till end of October as such.
Okay. So that's
and
what
of course there were restrictions on the timing as well. There were timing restrictions as well.
Sir,
at different locations, there were different period of time. In Bangalore, you had a weekend curfew, and you had again a closing time.
So is it okay to say that once this restriction goes away, we are back? We would be most probably in terms of footfalls back to pre-COVID level, almost.
See, I'll again clarify for us. This consumption is what we focus on driving to the malls. There is, there's a certain profile of customer that comes and spends money at the mall, and they are coming in. Therefore, the average ticket price per person is higher. And we'll continue to focus on consumption.
Okay. And one final question, sir, this under construction malls that are nearing completion at advanced stages. Sir, all these 4 malls, when do you expect the full-fledged rentals to kick in all these 4 malls? Full-fledged rentals.
So we expect Indore and Ahmedabad to open in H1 of FY23. Right? So typically it takes about 3 to 6 months for all the stores to become operational. I would think FY24 would be the first full year of full potential rental in Indore and Ahmedabad. And for our Phoenix Mall of the Millennium in Pune and Phoenix Mall of Asia in Bangalore, which will open in FY24, one can expect that by middle of FY25, you'll start seeing the full run rate on the rental side.
Okay, sir. Thank you, sir. That's all from my side.
Thank you. Ladies and gentlemen, due to time constraint, we take that as the last question for today. On behalf of the Phoenix Mill Limited, that concludes this conference call. We thank you all for joining us, and you may now disconnect your lines.